Welcome back, everybody. We're in Unit 5, and this week we're going to talk about the exciting world of finance. Now, I know we have a couple of folks in the course who were accounting majors or have a minor or a cognate in fraud. So for you guys, yes, it is exciting. For the rest of us, and I will include myself in us, finance is probably the least attractive part of the security management job to me. But it's something very important. If you don't have the funds to do what you want to do, then you're not going to be successful. So we're going to talk about finance in 3 different steps. We're going to talk about their role. Then we're going to talk a little bit about some of the basic functions and very, very, very basic functions that you will need to do as a security manager in your very first job. Right? We're not going to go into real deep stuff, but we're just some of the basic understanding that will help you talk the finance language in your first job. And then we're going to talk about finance from an ESRM standpoint and how we bring them into the table and make them part of that family we're starting to put together of ourselves and HR, and now we're going to invite finance in. And so let's not get hung up on the numbers, okay? If you're not a mathematician, that's okay. You just need to understand some of the basic concepts because in your first job, your company, your organization, your nonprofit, wherever you happen to go to work, is going to do things a little differently than everybody else. The laws are the same. The rules are pretty much the same, but the methodology is going to differ. It's going to look different. So I'm just trying to give you some examples of how you meet those basic rules. But don't get hung up on the fact that you need to know how to do a line item budget the way that I show you, because when you get to your first job, it's likely to be different. You just need to understand where the different items come from. On top of the basic functions of the finance department, we're going to talk again about some of your financial responsibilities and some of the things you'll need to do, some of the tasks, right? But most important to us as a security manager is once we've learned the basic things we need to do, the administrative side of finance, let's go back to what our most important role is as a security manager, and that is to evaluate and mitigate security risk. So we're going to talk about some of the risks that a finance function might have and how that might blend in with the rest of the enterprise and fits into our ESRM model where you're, again, looking holistically at all of the risks that could affect the enterprise, the organization, the business, the enterprise, and how you can mitigate those sometimes 2 at a time, 3 at a time by single efforts on your part, which just makes your program more powerful. We all know finance departments have to do with one thing, that's money, right? It's very intuitive. But what do they do with the money? And this is not a finite list of all the things the finance department does. In fact, before we go through this list, you won't see anything about the fact that they handle all of our tax records and implications and preparation and some of the mergers and acquisitions work. There's an awful lot of things that a finance department does besides the things that are listed here. But for the security manager to understand is that the finance department, it takes in money from customers, right? Collects the receivables. It processes and makes the payables. It pays the bills. So if you get a bill from a company for guard services, you contract your guard services, let's say, you get that bill, you would look at that bill, you would make sure it's accurate, make sure it reflects the actual charges that it should, you would sign off on it, send it to the finance department, and the finance department essentially pays the bill. And they do that on a contractual basis. In a certain number of days it needs to be paid, and it needs to be paid in installments or milestones or whatever the terms and conditions of your contract is with that guard company. But the finance department essentially is the one who releases the money. You would not sign a check and then put it in the mail and mail it off on the company's checkbook. Centralizing that makes sure that there are controls. They procure goods. In procurement, purchasing, if you need something for the security department of any kind of substance, now when I say any kind of substance, you need to go buy pens. Most companies will allow you through either a petty cash or a corporate purchasing card. I carry an American Express card that my company gives me. If I need basic supplies, I go and buy them on that. But anything of substance, anything over several $100s, really, you would go through and write a purchase order for, and the finance department would process that, find the right price for you, find the right supplier, and buy those things on your behalf and get them sent to you. This keeps you from going to people that you know to buy things. It keeps you from overpaying for things, and it also allows them to bundle things. If I'm asking for pens and the other 50 people in this class are also asking for pens, we probably could get a better deal if we bought 50 rather than one at a time. So they buy goods and services, and that's called indirect procurement. So they're buying tools, utilities, office supplies, paying for the lawn care, buying paper goods, those types of things. Those are indirect. And they're indirect because they don't directly touch the product or service that you're making. So if you're in the electronics business and your company makes televisions, you work for LG, Samsung, Magnavox, whoever that makes TVs, your security equipment wouldn't directly touch that product. But the plastic used to make the cases, the components inside, the printed circuit boards and the like, to make that flat screen television, if there's any other kind of television, I probably should stop calling it that, but televisions, right? That would be a direct purchase. So procurement handles indirect and direct separately because direct is handled differently from a tax perspective. Obviously, you're not going to be taxed very heavily on the raw materials you need to make something as opposed to those things that you need to operate. The raw materials are absolutely necessary to make the product. The raw materials are the indirects in some cases. Short blip there, sorry about that. So the indirects and the directs, I think you understand the difference. One touches the product directly. It goes into your finished good. And even if it's the box that you're going to send it out in, that's going into your finished good, right? It's part of the thing that you sell. You sell the packaging, you sell the actual product that you have. Those things that go into that would be considered direct procurement. And the indirects would be the things that you have to support your facilities, your people, those types of things. One of the bigger tasks that a finance department does is prepare financial statements. And that goes in line with the last thing on this list, which is the Sarbanes-Oxley Act. It's a 2002 piece of legislation written by Senators Sarbanes and Oxley, one of Maryland and one of Ohio, if I'm not mistaken. And basically it was a reaction to the reporting that some companies were doing. Think about WorldCom and Tyco International and those who were, their books didn't quite match reality, and investors got burned very heavily when those companies ceased to exist. And so Sarbanes-Oxley Act requires certain reporting. It requires officers of a company, when they sign off on financial records, to understand those records, and puts them in the box of going to prison if indeed they sign off on bad financial records. It also has requirements for storage of records, how long you must store things, including electronic records. For those of you who are in cybersecurity, those electronic records need to be protected and archived properly. But the financial statements and tax documents are a very important part of finance that really don't touch us all that much as a security manager, but projections do. Excuse me, and I'll tell you why. If indeed a quarterly projection says that next quarter your company is going to have a big drop in the number of sales, thus a drop in the amount of money coming in, you may very well be asked, in even a large company, to stop spending as much as you normally would in that quarter. And if that's the case, and the vast majority of your spend is manpower, like the contracted guard service we talked about, you have to be able to be nimble enough to adjust that. So projections are very important, because when projections tell you that either you're overspending on your own budget, or the company's going to have a lull in receivables and the money's not going to be available, you may need to adjust your fire and adjust your program some. So those financial projections are an extremely important thing for any department manager, but especially in a manpower-intensive thing like security management, it's hugely important that you understand when projections come in, that you look at those and understand whether or not the company's going to have ups and downs. They all do. Great companies, poor companies, all have ups and downs. And it's up to you as the security manager to understand those projections and how they might impact you. So, how does this mesh with what you do as a security manager? Procurement or purchasing or buyers, they're called different things in different places. Your security expenses are generally indirect expense. I've only had a couple of instances where security expenses, because of regulated products, were absolutely required as part of an indirect. There was some equipment that was considered direct because we had to sequester it, government contracting kind of stuff. It's pretty complicated and very, very rare. Almost everything you do will be an indirect expense. And the reason that's important is that indirect expense is the one part that's pretty manipulable by finance when things aren't going good for the company, right? Procurement's arm will do the buying that you need. You will recommend, different products and different suppliers, but procurement, making the final call on who will supply something, is a hugely important thing from an integrity standpoint. You do not want to be the guy that says, I want to use company A because I have friends at company A and I trust my friends at company A. You can offer that as a piece of advice to procurement, that you understand the company and you trust people there, but you don't want to be the one to make that call because it very much looks like you are handing business to your friends. And so the procurement arm is what keeps you honest. They handle bids for business. They will find bidders for certain projects and send out those bids to them and say, how much would you do this for? And those numbers matter, as do the qualifications for the bidders. But procurement keeps you honest and keeps you looking honest. So when you get to your first job, make friends with procurement and let them do what they do best, and that is finding the suppliers that you need. Projections, again, projections for the future tell us that, the company may hit a rough patch. So you may need to cut back on some things. You may not be able to spend what you planned on spending next quarter because the company's going to have a slow quarter. And again, that's cyclical. All business goes in cycles, but you need to understand those projections and be able to look at them and understand that. And then the immediate reporting. Here's a report at the end of an accounting period, be that a quarter. Let's call them quarters. Sometimes they're monthly, sometimes they're every 4 weeks, which is a little different, right? But the reporting will tell you this is how much money you started with in your budget. This is how much has been reported spent to date. And then you need to figure out how much you've spent since that date, because there's always a cutoff. It's a snapshot, right? So if they say as of the end of the month of September, you spent $200,000 of your $500,000 budget for the year. So you're less than half spent. It's the end of September. But if you have a liability out there, something you just spent $150,000 on that didn't quite make the report, you have to know that yourself, right? So that you can add it in. But it's a run rate thing. And by run rate, you've been doing run rates since you were a kid if you got an allowance. Mom and Dad gave you $10 for the week. And if you spent it all on Monday when they gave it to you, you had nothing for the rest. Your run rate was all up front. Smart people put away $1, spend the other $9 over the course of the week, so they always had a little bit of money if they wanted to go do something. They wanted to go to a movie, or, good luck going to a movie on $10. But I think you understand. You wanted to buy something small. You were a kid, right? Come Friday, you had no allowance left. Your run rate was too fast. You didn't spread it out over the course of the period. And run rate is very important for you to understand because it will help you make sure that anything that comes at the end of the year that might bite you, that you might need money for in your budget, is not going to be left hanging, that you have to go back and ask for more funds. That's something that's not normally looked at very favorably and is oftentimes rejected. So keeping track of reporting when it comes in to understand your run rate to see if you're spending at an even keel, or at least if you're not, you understand why, is very important. So the procurement, the future projections, and then the reporting back on how your spending and your run rate is going are 3 things that are extremely important interactions between finance and the security department. The next important part of interactions between finance and the security manager are the budgeting process. So each year you will be asked to prepare a budget for your department. And we'll talk about different ways to do that in just some examples. But the two types of expenditures that you normally have in security would be operating expense and capital expense. And I'm going to try to give you a very basic idea of what the difference is. So operating expenses are normally the day-to-day things you need to operate the business. Right? You need office supplies, you have vehicle costs, payments for your services, the laundry that needs to be done if you're running a restaurant service, lawn care, security guards, housekeeping. Those are normal operating expenses of every business. The travel that people take to go on business trips, those are normal operating expenses. Capital expenses, or CapEx, are longer-term investments in the business. So big pieces of equipment, buildings. You're a manufacturing company and you want to buy a manufacturing plant. That would be a capital expense. And a smart security manager understands that both have their place. And the difference in the two is how they're handled from a tax and recording aspect, really, for you. You're going to pay for both of those up front, but you're able to report them in a different way, and the taxation is in a different method. So operational expenses you just pay for just like you would for your home, right? Let's put this in terms of a house. You pay for your your lawn service, your cleaning supplies for your house, even a vacuum cleaner. You probably just go buy that. That would be an operating expense. It's part of running a house, right, or an apartment. But if you're going to take a loan out on that house or condominium, right, that mortgage, more of a capital expense. The person who's selling it gets paid all up front, but you're paying for it a little bit at a time. Now in business, you're actually loaning that money to yourself, but you're reporting it a little at a time. Because if you had to report that you spent $200,000 on a condominium and you only make $50,000 a year, basically you're reporting that you're broke. But on $50,000 a year, you might be able to get a mortgage for $200,000 and pay it off over time. So think of CapEx as a loan you give yourself And when you report it, it makes sure that people, when they look at your business, they don't see that you spent a lot more than you take in, and it makes your business look bad from that perspective. And then, of course, there's tax implications with doing it as well. So OPEX is paid for immediately and immediately counts against your budget. CAPEX, capital expenditures, are paid for immediately, but they count over a period of time. And you list them on your budget as depreciation. And so a capital asset, the thing you bought, depreciates over time. You owe less and less on it. And by the way, it's worth less and less, because depreciating assets are like a car. When it's new, it's worth, say, $40,000. The next year, it might be worth $30,000. And eventually, that car is worth $500 at a scrapyard somewhere, perhaps. And those are the cars I normally drive. But the CAPEX requires you, or allows you, to spread out the amount you paid for that over time against your budget. And it also allows you then to pay taxes on it in that regard over time, rather than one big tax implication at a lower rate. And sometimes that the capital expenditures can go 30, 40 years almost, right? They can go a very, very long time or a short time, depending on what you're buying. The CAPEX is tied to the useful life of the thing you're buying. So if you were going to buy let's say a copy machine printer, right? A multifunction device for an office, a big copy machine, right? You're going to buy that, say, with capital expense. You're a small business, that's going to be a capital expense for you. You can't capitalize that over 40 years because it's not going to last that long. There is information to tell you what the normal lifespan of such a device is for capital depreciation, and that is how you may put it on your books. So rather than have one big hit where your company took in, let's say it's a startup and you made $100,000 in profit last year, but you had to spend $14,000 on a printer, that would make it look like you were really playing it pretty close, right? But if you can spread that over 5 years, then you're able to say, I only paid this much per year for that printer. So it's almost like a loan to yourself that you're able to spread out on your books so that your books are cleaner, because you understand that you'll really be paying for something that lasts a long time. Okay? If that asset then becomes impaired, which means it's no longer useful. Let's just say that that copy machine only takes a certain size paper, and they stop making that size paper. Okay, or printer ribbons for it. In the copier, the ribbon inside the thing that makes it transfer to the paper is no longer available. You can't buy them anymore. No one makes them. Let's just say that happens. You have an impaired asset. You have something that you purchased and you were paying for over X amount of time on your books, and you can't use it anymore. You can call that an impaired asset. You must destroy or dispose of it in a proper way. But then you can stop writing that off on your depreciation, and you can just pay it down immediately and say, we're done with this. The useful then, the real value of it is next to zero, so it's scrap value, and you basically write it off. So capital assets give you a couple things. They make your books look cleaner because you're really paying for things over time that last over time, so it's the impact. There's a different tax rate on capital expenditures. Don't really need to concern yourself with that, but finance does. They're a line item on your budget. So when you write up your budget for the year, you're going to spend X amount on guard services and X amount on equipment and X amount, and there's going to be a depreciation line, and that is the total of all of those capital assets that you bought and what each year is costing you on those, based on the length of time and the amount you paid. And then if the thing becomes useless at some point while you're still depreciating it, you have the opportunity to write it off. It's not as simple as I said, but understand that each year you should go back if you're capitalizing on anything and see if it's still being used and if it's still useful. Because if not, you may be able to write that off and get it off your books immediately. So, the takeaway from the last two slides: operating expense, day-to-day operations of your business and your department; capital expenses, things that last over time, big ticket items that you want to spread the cost of across multiple years so it's not a huge hit to your budget in that first year. You can spread it out over time. The folks in finance will tell you whether or not something is eligible to be capitalized. You shouldn't make that call. You'll understand it at some point. You'll assume that, and you get it confirmed. But they will make the call. They will tell you what the depreciation is on it and how it will hit your budget each year, so that you can logically budget for it across time and not have that one-time big hit to your limited funds that you have for that year. That's your takeaway. That's all you really need to know about OPEX and CAPEX to at least have a general idea when people start talking about it in a room in your first job, that you won't have that look on your face that you're totally confused. Okay? So let's jump to budgeting. So when you budget, in your first job, no one's going to expect you to be a budget master. Okay? So relax on that. No one's going to expect when they hire you, they say, here's your budget. They hand it to you. No one's going to expect you to understand it totally in your first job. When you form a budget, you have two ways you could do it. It's zero-based or cost-based. Those are the two major ways to form a budget. Cost-based budgeting, it takes what you spent last year or over history, and then it just says add or subtract from that. So you may get a budget edict saying, your boss hands you your budget for the year, and he says, okay, next year your budget growth can be 2%. Or perhaps, the company's going to have some additional things they want to buy. They want to reallocate some funds somewhere, put it into research and development. They're going to take a little bit away from the support functions like security, which is a support function in most organizations. And they're going to say, take 2% off your budget next year. You got to cut 2%. If you just go through and take 2% off of each line item, or a combination of line items, and you get to 2%, you're doing cost-based budgeting. You're taking existing numbers and you're adjusting them up and down for either inflation or some deflation or some edict that your boss has passed to you about where your budget needs to go. That's cost-based. Zero-based means you start with a blank sheet and you list all the things that you potentially need to buy with your budget, and you calculate how much you think that's going to cost from zero. So history really doesn't play into it. I've never seen anybody be able to really do a zero-based budget without some history. You need to know what you spent things on, and you need a general idea of how much you spend on those things to start. So most budgets are a bit of a hybrid. You're looking at each line item. You're saying, last year I spent $500,000 on guard service. And I know the guards are going to get a raise of 3% this year. And I know that I had a little bit of overtime last year. So I'm going to start with how much they're going to make, and I'm going to build it up from zero. You're kind of doing a hybrid, right? You're taking what you spent last year, you're adding in a raise, you're adding in a little bit of overtime based on your history. But you can start at zero and say, okay, I spent $500,000 because I used this many hours of guard service, and it cost me this much per hour for service. And you can start at zero and build it up, and you should come out right about the same number. So it's normally a hybrid of both, okay? The zero-based budgeting takes much longer to do. It's a great exercise to do, and some people do it annually. Others do it every other year or every couple of years. Really start at zero and understand whether or not the numbers that you've put in those lines make any sense. And the reason I say that is you really are managing to a bottom line, and I'll show you that in a second. So the numbers that make it up are a little less important, but still you need to rationalize those to make sure that you have the right bottom line on your budget, the right end total that you're going to spend. So in the next slide, I'm going to pop up a really simple spreadsheet, that example that I put together. And it's an example of zero-based and cost-based budgeting hybrid, because I kind of knew how much I spent on things, and I kind of knew what some of the costs were. I didn't have to build it from zero. But we'll look at where I come up with some of the numbers, and then we'll look at what the total is. And that total is really the most important number, because that's the number you're going to have to hit. No one's going to worry too much if you spent a little more on guard service and a little less on equipment, as long as the two numbers together didn't come out to be more than you had anticipated in your total budget. Now, every organization has their own method, so you really should ask, when you're handed a budget, where am I expected to manage to? Each one of these individual lines, do I have to come in under that budget or at that budget for each line? Or are you expecting me to manage to the total on the bottom? Which means you have a little flexibility. If you don't spend something on office supplies that you're going to spend, you might be able to spend a little bit more on equipment, right? So understand whether or not you're asked to manage to a bottom line or each individual line, and you'll see that in a second. And cost-based research, just understanding what was spent. So if you're going to your first job, you're not going to know every little thing that the security department is expected to spend on. There could be nuances. So understanding what your predecessor spent, or what the expectations are, what the history is of spend in the security department is very important, especially when you do your first budget. So let's take a look at a simple line item budget for a security department, a very small one. Okay, so this is kind of an eye chart here, guys, and I hope you can see it. But here is a really simple line item budget that I worked up just for the class. Okay, so I'm looking at my expense items here, and I have guard services. I contract guard service, and they're going to cost me $450,000 in the anticipated year. Okay, it's an OpEx item, right? It's not something that's supporting directs. It's not something I'm going to spread over time. I have to pay for it when it comes in. I'm not buying it on installments, right? It's going to cost me $450,000. I will get monthly bills, but it all needs to be paid for in that year, right? I have consultants not associated with capital projects. So I have some investigators that help me with background checks, perhaps. I have others that help me plan how I'm going to put in some new organizational changes, those types of things. And I put $50,000 in for consultants. Don't underestimate the value of consultants. Every new security manager says, I don't need those. I understand everything. And then you realize as you get older that no one understands everything, and it's good to have experts in certain little nuances around. Integrators. So these are the people who fix your camera, alarm, access control, gates, those types of things. They're called systems integrators. Again, not associated with big capital projects, just the day-to-day maintenance on those types of specific security equipment. Here I put in $30,000. Monitoring fees. You know, after hours, I have a couple buildings, let's say, that are separate from my main building, and I put those on a rented alarm system just to know if somebody broke in, and I have to pay for that service, so I put in $5,000 there. I put in some money for vehicles. You know, if you have contracted guard services, like up here, little word to the wise, rent the vehicles from the guard company. They look extremely expensive when you do it, but they take all the liability away from you when they do that. And I will tell you that security guards are notorious for hitting things. They drive a lot, right? It's not a matter of that they can't drive. It's just they're driving in circles all the time on odd shifts and they're tired. It happens. But you have vehicle expenses, awareness materials, you know, printing, web design, those types of things. You know, you could easily put in those awareness materials. You could also talk about printing costs for visitor badges and those types of things. I put in $5,000. It's usually not a huge expense. Communications, radios, you have FCC licenses for your two-way communications, cell phone bills, things like that. Repairs and maintenance, you know, could be anything. A lot of organizations require you to pay if a person comes and changes a light bulb in your office. They will charge you a fee against your budget for internal charges for maintenance. You need to understand that. But again, these are things that your history will tell you what your predecessor had to pay for. So you'll know that those things are there. Now, salaries are salaries for internal, not these contracted guards, but for the internal people that you may have working for you. In this example, I have 2 supervisors that work for my department here, and their combined salary is $176,000. And down here, I think I listed it, one at 85 and one at 75, plus a bonus target at 10%. So that 176 is that number. The security manager's salary, your salary, if you're doing the budget, normally would not fall to your budget. The person who's the lead of each department, they roll up into the salary budget of their boss. So your boss is the one who takes care of your salary. You would take care of the salaries of those you supervise. Benefits, I think I used 30% or so as a benefit said, yeah, 30% of salary. Again, that's all stuff that will be fed to you. When you do your budget, someone will tell you what your salaries are going to be next year, because that's the approved amount HR has. And they'll tell you automatically what the benefits will cost, but they go against your budget normally. They're not normally paid centrally. And they'll tell you what the percentage is. And then you have depreciation. So back in, a couple years ago, I put in a access control system in this particular facility, and it cost me $600,000, and I'm paying it off on a 10-year depreciation. So simple terms, $60,000 a year. Obviously, that will vary based on the actual lifespan and what the thing is worth at the time. But let's just call it even depreciation in this case as an example. So the depreciation line, and finance will provide me each year with what my depreciation is. They know what the number is, and they will provide it to me, and it always shows up in your budget. Even if you're in a small organization, your financial lead in a small organization will tell you what your depreciation amount for each year will be. You can argue that based on the fact that you no longer have that thing you bought. It wore out. You got rid of it. You could write it off and pay it all off in one shot, based on the value of it when you got rid of it, which normally is next to nothing, scrap value. But they will give you that number. So the things here that you really need to concern yourself with are the actual expenditures that you have that you can control. So salaries, benefits, depreciation, those are going to be fed to you. really you need to understand what you need to buy, the little things you need to buy to keep things going, and then the services, the people, the contracts you'll need to make your department roll. So this $450 is for 2 guards around the clock, by the way, and I put that down here. It's costing me $25 an hour bill rate, plus there's some vacation time that I have to pay for, incentive payments that I pay for. So it all adds up. But this is a simple line item. What I want you to understand is this is all it is. What are the individual things that you might spend money on? And then what's that amount that you're asking for that year? And then over here, list the things that you plan on. You go into a little more detail so that you understand that you've got everything covered. So you come up with a total, $856,800 would be my total budget for the year, not counting my own salary, right? A contingency. Normally, a finance department will tell you what your contingency amount can be, but you always ask for a contingency. What is our contingency? 10% is not unusual, and that's things you didn't think about, right? Things you forgot to put up here, things that came along. You didn't think that copier was going to break. It's almost brand new, but you had to have the guy in to repair it, and he wants to get paid. So contingency can be very important to having a little bit of it's a slush fund, okay? So you added up with $942,480 of your total operating expense request for the year. Now, I'm also going to ask for capital items, and I ask for the entire amount that I'm going to spend. So electronic security equipment, right? I want to put up a new set of cameras. They're going to tie into my alarm and access control system, and I want to spend $100,000. That would be my capital request. The guardhouse that I have for these 2 guards, one of them sits in a guardhouse to clear people when they come on the property. It's falling down, so I need $120,000 to fix that, right? To basically totally renovate, or take it off its foundation and put a new one on it, right? And then I want a watch tour system. When the guards go around and they check the buildings, I want to make sure that they were there. So I want to give them a system that clocks them in different places so I can know I have a record they've been there. So I'm going to ask for $228,000 of capital. Now, that is a negotiation, and I need to sell that to people, and they need to say, okay, you can have those things. But next year, that's going to add to my depreciation, right? So I'm still paying off on this $60,000 access control system I bought, and then I bought all these other things, and maybe I'm going to spend another $20,000 each year on top of that. And I'm not going to just be able to increase my budget. They're going to give me a finite line. They might just say, $1 million is what you're going to get. So I have to consider, what else could I reduce? What value has this capital given me that allows me to reduce? So maybe, just maybe, I'm going to put these cameras in. Maybe I only need 1 guard, not 2, because I'll be able to have the 1 guard watch on camera what's going on, and the other one doesn't need to sit in the guardhouse at night. So I know it's a little complicated, but what I want you to understand is that you have a line item budget. Certain things, salaries, benefits, depreciation, are provided to you. Other things you need to figure out, and you'll tell us what they are. Again, history will tell you what they are. The first job you go into, pull the old budget, see what they spent on. Pull the old bills, see what they spent on. It gives you a great idea of what things that may be coming your way. And then you have your capital request, and this requires your forward thinking to understand what large items you need to be successful, and how you might be able to reduce your operating expense by spending more on capital and having equipment to take the place of some of these other expenditures. Very complicated, I understand. Not going to be a lot of tests on line item, but this is just one methodology that I wanted you to see. So the example we just looked at was a combination of cost-based and zero-based, right? The spend to the bottom line. When we had all of those things on the top, you might not spend $450 on guard service. Perhaps you find out that you have to close the guardhouse, and that's where the guy sits, so you're not going to have that open at night anymore because you're repairing it, right? And you don't need that guard. Then you would only spend maybe $420,000 next year on guard service, not $450. Well, you're not going to necessarily give that $30,000 back because you might need it for something else. You underestimated the vehicles because your vehicle broke down and needed a new transmission, and you had to buy that. The $942,000, that bottom line, was what you're normally going to be asked to manage to, and those numbers up top are just ways you built that. So you need to make sure you understand from your first boss, when you get your first budget, what number you're expected to manage to, and you say it just that way. What number are you going to look at as my success number? Where am I expected to be? Is it each individual line, which almost no one does, or that bottom line total? In our case was 942. If he says manage to, he or she says manage to that 942, then those numbers up top, you try to stay close to them, but you understand how you can adjust it, right? Every organization has their own methods, so be sure you asked. And again, don't get hung up on what I think what you really want the takeaway to be is there weren't any fancy mathematical equations going on there. It was all addition. It was just a matter of understanding how much something might cost you in the course of a year and adding it up together to build a budget. So don't get hung up on the fact that there was math there, because it really wasn't anything but a simple addition problem, which every one of you can do easily. If I can do it, you can. So that's an example of a line item budget, normally used with security departments in both big and small places. But it's a very simple way for you to communicate with your finance department about what your needs might be for the coming year and what your needs might be on your capital expenses as well. Based on what we know about the roles of finance and what you've seen a little bit of on the things that you need to do, let's shift gears a little bit and talk about some of the potential risks to a finance department. So SOX, which is short for Sarbanes-Oxley, it's a big risk if they don't have the right records to prove that they're doing what they say they do, or that somebody is manipulating records, right? Huge problem for a finance department. Obviously, when WorldCom and Enron said they had money they didn't have because they manipulated their records, that was a big problem for a lot of people. And in fact, it hurt a lot of people who had investments in those companies as part of their retirement. And then that money was simply gone when the company folded and closed doors in a single day. So SOX is a huge risk if not done correctly. Personal surety kind of falls into that. So can you imagine if a finance department hired a new bookkeeper? And by bookkeeper, I'm talking about someone who simply does the most basic functions. This is not a CPA. This is not a someone who's an analyst, really. This is someone who just works in the finance department to handle simple day-to-day tasks. But can you imagine if that person has either significant personal financial issues, or worse yet, has convictions related to financial matters? Would you really want someone who works in your accounts payable department to handle personal checks? To handle business checks. I had an instance one time where a contractor was hired into a position where they were part of the accounts payable group. So they were issuing the checks to vendors for work they had done. They knew what the payment terms were. And so and how many checks, so you have a certain vendor that does a lot of work for you. You might be issuing them 10 different checks in a month. 9 of them get there. When the 10th one doesn't, that vendor may not call right away to understand where it is, right? There's a lot of churn. There's a lot of cash flow going on there. So this person was manipulating the checking account to put that money into their own personal account. And in a very short amount of time, hit us for a $100,000 loss. So personnel surety, and in fact, when we went back, found out the contractor who brought the person into us did not do a proper background check, and she did indeed have financial fraud issues and convictions on her record. So personnel surety is a huge issue for a finance department. Access to data, who has access to the data? Again, a SOX issue, and potentially a privacy issue. We're talking about maybe salary data, right? Access to data, a huge risk for a finance department. Petty cash storage for a smaller company could be a huge risk because it's a double whammy kind of thing. Let's just say you have someone who's in charge of petty cash for the office. You want to take a potential customer out to lunch. So you go to petty cash and you ask for $100 to go take them to lunch. You come back with a receipt for $90 and you give the $10 back, and that goes in the box. If petty cash gets manipulated, it's unfortunately very common, and petty cash is starting to become something that's more of an antique than an actual practice anymore for this reason. Petty cash seems to dwindle and the records seldom match up. But it's a double whammy because when you find the person who took the $10 or $20 because they needed gas money, they knew the petty cash was there, they planned on putting it back, they stole, okay, you're out $10. Now you're also out an employee who you have invested in training and in background checks and in hiring and all the investments you make there. So petty cash storage, in and of itself, you may have very small losses, but it hurts morale, and it also gives you significant costs in replacing people. And then they have a significant risk, and again, this is not an all-inclusive list by any stretch, but a link into the security manager is check fraud, in that when you have a big company that has checks that go out to different customers, those checks sometimes get copied, or people just print their own checks with your account number on them and go somewhere and cash them. So I have seen company checks from my own company cashed in grocery stores throughout the U.S. as payroll checks, when the original check number actually was paid to a vendor somewhere. Someone in the vendor shop took the check, made a copy of it, made a few adjustments with maybe some whiteout, or maybe went to the full extent of reprinting the check, right, having checks printed or doing it themselves on a high-speed printer, and then wrote checks to themselves and cashed them. There is something called positive pay, which large companies subscribe to, which basically, when it gets to your bank for payment, that bank will not accept the check because they know they have access to your records to know who the check should have gone to. So if check 123 was to ABC Flooring Company, and it comes back, check 123 was written to Brian Wisniewski, the bank will automatically reject that because the payer and the number and the amount wouldn't necessarily match. They send it back to the first bank of record that accepted it and said, I'm sorry, but you've been defrauded, and it protects your company. But check fraud investigation takes an awful lot of time in companies. It's a big thing for finance because it throws the books off, and it does take time. The security manager is often asked to investigate those because it involves law enforcement on the outside, and you become the de facto law enforcement liaison. So those are some of the possible risks that the finance people worry about. So now we put this into the ESRM model, right? We've got finance at the table. We've had HR at the table. We understand the risks that HR talked about. And background checks are one way to understand personal surety, to understand we're not hiring felons or people with significant financial issues into the finance department, right? Understanding who has access to the financial records. Some of that is understanding who has access to the place where those records are stored. And guess what, security manager? You normally are in charge of access, handing out keys and access cards so people can get into places. Understanding what's being purchased and where it goes is critical to a finance department so they can stem fraud. So purchasing fraud is a big thing that you might actually be asked to get into, and then understanding, the purchasing method is one way for you to help mitigate that risk for them. So do these match other people's risks? I think they do in some ways. So let's try that. Personal surety. Human Resources does the background checks because they don't want to bring in a liability in the hiring process. They're more concerned that the person has the skills to do the job, that the person doesn't come into, let's just say your business is a daycare center. Human Resources does not want to hire someone who has a child molestation charge in their background, right? So they run a background check. So they have a dog in the fight on background checks. Security, you help with the verification of that. We went over that before, right? If there's a question about a background check with your court and your CJ contacts, you can go in and help kind of figure out what the circumstances were of those to see if the person's acceptable. But finance needs that background check too to make sure the person, not that, although they're concerned about whether the person in this case would be a child molester, obviously, because we're all concerned about such a horrendous crime. Their immediate concern is that they were going to hire this person to work in the finance department. And does that criminal background have them also, people with criminal backgrounds spend time in prison often have financial problems because they haven't been able to get it back in the job market. So that single background check can be looking for multiple things. What you've got is two different risks. One, a financial risk. One, a liability risk from bringing in someone who might do you harm. But you're going to mitigate them both with the same background check. So from an enterprise security risk management perspective, you need, as a security manager, to make sure that the background checks look at both finances and criminal histories. And if you're just looking at criminal histories, you might be helping the HR department. But if you don't also look at financial backgrounds, you're not helping the finance department who has identified to you a risk. So one single mitigation, a thorough background check in this case, helps both of those departments. From an enterprise security risk management, you've looked at the risks and you found a single mitigation, when done right, that can close both of them. That's a pretty cool thing, and it saves you a lot of time and effort, and now you have closed up two significant risks to the business with a single mitigation. So the ESRM model, we now added finance to our list of people at the table, right? We have security, HR, and finance at the table now, and then we've got more seats we're going to fill. The finance department is going to define their risks to you. Then you're going to take those risks, then you're going to match those and order those with the ones that HR gave you and the ones that you have yourself. But now you're looking at the whole organization holistically. What are the biggest risks? Rank those things, right? In a bank, the biggest risk may very well be fraud. Whereas in the nuke plant, the biggest risk may be an attack, right? More of a security-based one, and you really want to know about criminal histories, and you want to know about other types of history, not so much as the financial one in that particular mitigation, right? So you close the gaps that affect the enterprise. You're looking at all of the risks, not just the ones that you think are security risks, like somebody breaking into the facility. You're now actually looking at the enterprise risk. And we've added finance to our list, and we've come up with a whole other set of risks that we can put in and rank and start to handle from a really holistic view so that we secure the entire enterprise in the right way. Okay, we're at minute 46, and I'm tired. And I'm sure that some of this was a bit confusing to you, especially if you've had no exposure to it. Just to understand that the budgeting process can be very simple, especially if you have the history when you get in your first job. No one's going to expect you to understand it fully. Have a basic understanding of the difference between operating expense, those day-to-day expenses, and capital expense, the big ticket items that you're going to need, that you're going to pay for essentially over time, and they're going to hit your line item budget over time so that you don't spend all of your money in 1 year on something. That's the big part of it. If I had to buy all those things on the bottom of my line item budget for $228,000, I believe it was, that would have taken, gosh, a good 30% almost of my budget for the year just to buy those things. If I'm able to spread those over time, I can afford them. And that helps me. It also helps the company. And then it also allows me to get rid of those things if they don't work anymore and write them off and get them paid for and be done with them. Okay, so concentrate more on the fact that finance has risks, individual risks that are part of the finance game. And calling in your finance person, your contact in finance, and having one, and getting them to articulate what their risks are in your business. They're a little bit different for every business in the finance world. Again, banking might be a little different than somebody who's non-banking. But getting them to articulate what they consider to be the risks and then looking at those holistically is the key to ESRM, the key to real security management. We talk about a little the nuts and bolts in administration, and that's important. But as a security manager, understanding how you manage security from this enterprise is hugely important. So just take away the real high-level stuff here, and I think you'll be fine. And you certainly will be fine for the quiz. So this week, you have reading. And in the reading, there are 2 articles. I did put them as live links. I've tested them. They work for me. I'm sure I'm going to get an email from somebody saying they didn't work. Look, don't panic when that happens. Everybody's got different settings on their computer, too. It might work for one person and not for another. I haven't found too many places where something I put in totally fails everybody. But if it doesn't work for you, just let me know, and I'll send you a copy. Somehow I've done that with people, send you another link, and we just get it done. It's not a problem. One of the readings in there is actually an online quiz, and it's about fraud. And you don't have to be a fraud major to understand the stuff. It's pretty cool, and you may not get many of them right. But when you answer the question with your best guess, it will come up with what the right answer is and why it is, and it helps you just kind of get a flavor of some of the risks in the fraud world that a finance department might bring to you. And there's a couple in there that's like, yeah, I never thought about that, but this could be an issue for the enterprise, and so as part of the overall risk management, I need to consider it. The lecture, you've seen, it was long. It's probably the longest one you're going to get from me, so thanks for muscling through it. And it's probably the most confusing one you're going to get from me. Let's do that now. There is a quiz. It's multiple choice and true and false. There are 10 questions. No 2 students get the same quiz, so let that be your guide. This is the time of the semester when everybody's grade starts to dip just a little bit. Everybody's getting into, the meat and potatoes, if you will, of your other classes. This one too. Don't be concerned with that. I don't want you to be concerned if you see, the first, let's face it, the first quiz was a 1-question quiz, right? The first writing that you did for me was your introduction. I think you all know yourselves well enough to get a 5 out of 5 on that introduction. The next one was a pretty easy essay, and everyone did fairly well. The next one, I've got a rubric to go with that one. It might get a little bit tougher on the grading. That happens. Don't be if you get concerned about your grade, you call me, because if I get concerned about your grade, I will certainly call you. I am not one that lets things, bad news is not fine wine. It doesn't get better with age. So if there's something bad happening, don't worry, we're going to be in touch. But don't panic. When you don't get the perfect grade on everything, that's not a reason for panic. That's part of life. Okay. So with that, keep your nose to the grindstone in this course and your other courses, please. If you have any questions, I think everybody knows how to reach me, but my number is published in the syllabus. Feel free to reach out. A number of you have now with different questions on different things on assignments and due dates and things, and I enjoy that. I try to get back to you as quick as possible, so please keep that up. And with that, have a great week, and we will talk soon.